Hi, this is a continuation of the financial seismology slideshow. Uh, as we showed in the first couple of slides, we divided the problem into fundamental versus technical. We call it crowd effect, and the complexity theory is responsible for what we see as crowd effect. But on the fundamental side, I thought that the fundamental analysis using neural nets was the way to go. Um, at the time, this is back in 1990, very few people were using AI, um, but I still think it's the best way to do it. Again, what I said before is we used looked at Graham and Dodd and a number of different sources for what fundamental value factors we needed to include, and then use neural nets to, you know, um, with about 20 years of back data on hundreds of stocks, probably a couple thousand stocks, divided into their own sectors or industry groups, and trained neural nets using the factors we had and the market price was our target, to figure out whether, how to map those fundamentals into a price. And I laughingly call this our Zillow for stocks model, because Zillow does sort of the same thing. Here's a real estate value problem. If you want to figure out what the price of your house is, you're going to look at lots of factors. Where is it located? What's your zip code? Home attributes, closets, garage, pool, demographics, taxes, market demand, interest rates. All of these are important in determining what the value of that house is. Similarly, with markets, with equities, we have to consider all of these factors: earnings, book value, cash flow, what industry are you in, interest rates, debt, inflation, a number of things, if we want to turn the crank and find what a reasonable price is. So, doing that, we create this series of actually there are 15 neural nets now in our stock valuation model, and it's a bit of a black box, but we can still ask questions. We can ask, if we hold all the other factors constant and just vary earnings, how does price change? And the answer better be, as earnings go up, the price goes up. Um, and we can also ask, how much does it move? Which are the most important factors? And so this graph shows the factors that we use down below here, and how much response we get, the relative importance of each of these valuation factors. And earnings and book value are the most important, which is the two factors that Benjamin Graham highlighted as his most important factors for determining value, which is nice. So we've incorporated this into a valuation tool. It's an app on Bloomberg. We also have a version on TradeStation, where these purple lines down below are our valuations, and the bars up here are the market price. And as we discussed before, you get periods where there's increased crowd optimism and it drives prices way over value, and then maybe a pessimistic period comes in, or some event that takes you back to reality. So it's always nice to know where the value is, because that sort of gives you an estimate for risk. How far have I got to fall if something really bad happens? So how does it compare to discounted cash flow? The Ford Group uses a discounted cash flow model, and they do very well. They've got a big market share of people using it. So this is a graph of how overvalued or undervalued a tranche of stocks are. In this case, we used the S&P 500 from 2002 to 2013. It's about 29,000 samples in here. And the blue lines, or the blue bars, show on the right, here's average annual gain. So the average annual gain for that tranche of stocks that meet this criteria. So if you were 30% undervalued, then on the Ford model, the average annual return looks like about 6%, 7%. Looks like 6 maybe. So the green lines, the green bars here are our parallax model, showing if if you're 40% undervalued, the average annual return would be, something like 7.5%. It does as well. I mean, the takeaway from this is it does as well or better than a discounted cash flow model. And my point to equity managers is, why not have another opinion? Have the discounted cash flow model, have our model of value, and maybe you have a couple of analysts that you consult, and they have an estimate for value. Doesn't hurt to have more than one estimate. Let's see, next slide. So we also, in our tool on Bloomberg, we have the ability to run a back test. So we can say, for instance, this is an OEX. We valued all the OEX stocks over 16 years, and then we said, okay, let's sort those stocks every month by the valuation growth rate, and take the top 50% of them and buy them each month, hold them a year, and dump them. And by the way, we also want that set that we buy to have to not be downtrending in volume trend, to have low debt, and we want the value to be accelerating, to be moving up at the end of our period of valuation, if we look over a period of time. So here we have the picked set in green and how it performed. The blue represents all stocks. If you just bought all of them each month, held them a year, and dumped them, you get the blue line. And the contrary group here that had the opposite characteristics, the bottom 50% that had the opposite characteristics, would be the brown line. So what do we get? We get a 420 basis point spread against the market in this case. So this shows the value of using fundamental tools by themselves. This is not using any kind of crowd effect to create extra value for your clients.